Budget next year. The budget will not have a permanent impact on the market, says Ridham Desai of Morgan Stanley. In an exclusive interview with CNBC TV 18 to Udyan Mukherjee, he adds that the government should continue along the fiscal path of consolidation.
I think larger companies may actually end up benefiting from GST. The timing of GST has also become a little less certain, given how the Parliament session panned out in December. And I think it's going to be a lot harder now to achieve the 1st April deadline. So more likely we are going to see a delay in GST. But you know, GST is also going to be something that is down to execution. And we've been saying this to investors for the past year or so, that do not underestimate how complicated the execution is. We're talking about nearly 10 million firms coming online, 30 million digital signatures, and several tens of millions of transactions on a daily basis. If anything, it's actually more complicated than the currency exchange that has happened over the past 1 month. But of course, there is greater preparedness as well. There's no suddenness to this, so the system is, I think, far better equipped to deal with it. But we cannot take away the fact that there will be some uncertainty and some impact out of GST. Again, like demonetization, I cannot pinpoint exactly how much. And therefore, then we go back to the question on whether to buy equities or not. I think it's hinged on prices. I don't think we can confidently say where growth is heading, whatever my forecasts are, but I think I can surely look at share prices and say that it's looking attractive. And that's the reason why I think 2017 may pan out to be a better year for equities than say 15 or 16.
Big event of the next couple of months as we wade into 2017 will be the union budget. There are expectations this time that the government will do something to mitigate the pain it has inflicted on people. Should the market be expecting a lot from the budget?
Udyan, if you go back over the last 25 years, and you've covered the budgets as long as anybody has, I mean, which budget created permanent change in share prices? You can point out maybe one or two over the past 25 years. I mean, clearly I remember 1991 was a mega shift, and that clearly established a higher trend in share prices. I think budgets since then have brought about incremental changes. And I don't think we should rest our hopes that the budget is going to make a major difference. The policy environment is crucial. I think fiscal consolidation is crucial. We certainly want the government to continue on this path of fiscal consolidation. It's now bearing fruits. So to me, that is one important thing. The second is infrastructure spend. Again, given the weakness in private capex, it's imperative that the government continues to spend on infrastructure like it has over the past 2 years, and we'd expect continuity on that. Already the finance minister has told us in the last budget and the prior one that there will be a rationalization of corporate taxes. So I guess we'll continue to see that as well. And then there will be some tinkering at the margin which will bring impact on certain stocks and sectors. But I don't think it's going to leave a permanent impact on the marketplace. So I don't think we should assume or hope that the budget is going to bring about a major change. It will kind of cause a lot of volatility on the day. And in fact, I would say that even that volatility on the day has been declining over the last 20 years.
Is it your understanding or assessment that commodity prices have bottomed out globally? Now, on one hand, that might have positive implications for earnings growth for commodity companies, but do you think the trend of improving margins, which we had seen over the last many quarters, that may be actually a thing of the past as we wait forward, and we need to see more by way of improving volume growth, etc., to drive the kind of double-digit volume earnings growth that you are expecting at Morgan Stanley?
See, Udyan, I think it may affect certain sectors. So let's take the example of the sector that benefited the most from falling commodity prices, which is, say, consumer staples. So I think staples will struggle a bit as commodity prices stabilize or rise. It's not our view that we're in for a big bull market in commodity prices, but clearly they're off the lows. So the sweet part of the consumer staples earnings, which was rising gross margins, is behind us. Other sectors may actually not be affected in this fashion. They may in fact benefit. So I think at the end, it's about the terms of trade that India has, and rising commodity prices does upset it to a certain extent. India's terms of trade will suffer slightly. Therefore, we have to respond with stronger domestic policies to overcome that. And in the end, if we do that, then I think the aggregate earnings still do better, even though at the sector level, maybe consumer staples doesn't do as well. So this is actually reflected in the way we are positioned in stocks, which is we are underweight consumer staples, and we think it's going to be challenging in 2017 for them to generate earnings growth because their margins will be under pressure. But I don't think that applies for the whole market as such. So, materials will offset that by probably benefiting from this and will offset the weakness in staples. Other sectors like, say, technology are not affected at all. And they will, in fact, benefit if US growth improves. And given what's in the price today, which is everybody shuns technology stocks and stocks are as cheap as they've been, I would actually be positive on the shares of technology companies. And therefore, we are overweight technology. I think financials benefit from what is happening in the macro today. Deposits will rise in the system. Therefore, there's scope for better lending growth. And as the dust settles down on demonetization, I think people will probably come back into financials. Therefore, we are overweight financials. So I think these sectors are less affected by the question you asked. Consumer staples maybe is, and therefore you want to avoid that.